Okay, well, hello everybody. The purpose of this video actually is to tie up a few loose ends as we approach the end of the course and the term, and the exam is coming up. So the first thing I want to do actually is to go through these sample questions which I was asked to do that were in the exam guidelines. Now, actually, these are quite simple, but I will go through them and give you the answers anyway. Question 1. Suppose you have a well-diversified portfolio with a very large number of securities and that the single index model holds. If the beta of your portfolio was 0.2, sorry, the sigma, and the sigma for the market was 0.16, the beta of your portfolio would be approximately what? Okay, now for that, the actual formula that you would need to use is this one. The beta of the portfolio is actually the ratio of your portfolio's variance divided by the market's variance. In other words, it is 0.2 square divided by 0.16 square, which is actually 1.5625. Now they rounded it, okay, but I guess it is important that you actually do understand this formula. Otherwise, suppose answer E was not 1.71, suppose answer E was 1.5625, then you wouldn't know whether you should choose this one or you should choose this one. Okay, that's so the answer, the best answer for this case is 1.56. Question 2 is just a simple application of the CAPM. It is so simple, okay? So RF is 6 and beta is 1.2 multiplied by market excess return, which is also 6, is 12 minus 6 is 6. So 7.2 plus 6 is 13.2. Okay. Number 3 is a very simple question that I think we went through. This is, I think, from either Chapter 2 or Chapter 3, and I don't mind telling you, it's something that might well come up in the exam. Now, what is a margin call, first of all? Okay, so you buy 100, I mean, the answer is here, and there is an explanation. So I am really doing the third level of, clarification. So you buy some stocks, you buy 100 shares, and it's $45 each. So you're on your asset side, it's going to look like this, and it's 50% on margin, so it's half funded on borrowed money. So this is your own money, 2,250. And it's asking you that if a margin call is made at $30, what actually is the maintenance margin level? Now, it's very simple. You ask yourself, if the stock goes from 45 to 30, so it's dropped $15, and you have lost, therefore, 15,000, haven't you? Because you bought 100 stocks. So how much money have you got left in your account? You have got $750 left in your account. Okay, this is sometimes called liquidation value. When you open a stock account, or mark to market, or sometimes call your equity, but although I try to avoid using the word equity because it's going to end up confusing you. Sometimes it's called liquidation value. But anyway, you've only got 750 bullets left, $750. Okay, now so the price is now at 30, and it's going to wipe out your remaining money. Again, I don't want to say equity, but that's what people would say. So if the stock price was to drop from this point an extra $7.50, then you are completely done. Okay, all your money is gone. So $7.50 is the maximum pain that you can tolerate at this stage when the stock price is 30. So you can handle, an additional 25% drop in price. So we say that we will give you a margin call at 25%. Okay, that's what that stands for. So it is the point. So when we give you a margin call at X%, whatever X is, X happens to be 25 at the moment, okay, for this question. But whatever X is, it means you can just take a further X% of price drop before you are completely wiped out. Okay? Question 4 actually is just flipping the concept the other way around. No. Question 4 is not about margin calls. It's just fees charged on funds. Sorry, I thought question 4 gave you a margin call level and asked you to work out what the price is. Okay. This one, anyway, the answer is staring at you. Okay, so I won't go through it. Question 5, a hedge fund attempting to profit from a change in the spread between mortgages and Treasury is using a what strategy? Now, this question, I guess there are, like I've said many times, I think there is more than one possible answer. And you could argue until sunrise, which one is the best. But first of all, the official answer given by Professor Bodhi is relative value. It's not really directional. Directional simply means you are long or short. Okay, that's directional. You are at the mercy of market direction, up or down. Okay, it's not really talking about divergence or convergence. Okay, at least the question is not clear on either one of them. You could argue this is a kind of market neutral strategy, but relative value actually has a stronger fixed income flavor to it. People, understand relative value to mean you buy something that has a high yield, and then you short sell something has a lower yield. So if mortgages were yielding 5%, all right, and treasuries were yielding 3%, then by short selling treasuries and then buying mortgages, you end up with a net positive carry of 2%. Okay, now that is called relative value trading. You trade something, you long something which has higher value, and then you sell something which is more expensive. Okay, you could argue that market neutral is also a positive answer, but in all fairness, I think relative value is more suitable. Okay, so that's question 5. Question 6 to 9, 6, 7, 8, 9. Now, some of these actually appeared in one of the tutorial quizzes. So the expected return for stocks A and B, given these return patterns and these probabilities, expected return is simple. You just sum the product of this column and this column, and then this column and this column. Okay, for expected returns, the answer is C. All right. Variances. Now, I actually knocked out a simple spreadsheet here. So I just replicated the data for stocks A and B, and the variance of A should be this one. Okay, now you've got to be a bit careful. The numbers are correct, 216 and 121, but in the answer they gave that as a percentage, which is actually a bit misleading. The answer is actually this one, okay? So it's 216 and what's the other one? 121, okay? So you just got to be careful. I don't think these are percentages, because variances, you are squaring the sigma, so they become very small numbers, okay? Unfortunately, I think this is a typo. If you were to round this up, it should be 2.2, not 2.3, okay? In any case, I think these are a bit misleading, because it's actually 0.0002.2 or 2.16, okay? So just clarifying. No, don't worry too much about the absolute precision. Get the concept correct, okay? So these numbers are valid. The coefficient of correlation, what do you call that sometimes? It's the Greek letter rho, which is displayed like this, okay? Which is actually the covariance, okay, multiplied by the individual sigmas, okay? Sigma A, sigma B. Let me just check the numbers for a moment. All right, I actually I knocked out a spreadsheet, as I said to you, and oh, sorry, this one actually is divide, okay? It's not multiply. It's covariance divided by the individual standard deviations. So given the information, you actually can work out the covariance, and you also have the you also have to work out the sigmas, okay? And the answer for the covariance actually is this one, okay, 0.000076, and the individual standard deviation, they are 0.0146 and 0.01, and the correlation, so you can see, is actually dividing this one simply by this and this. You can see that in the formula in the top, on the top left hand corner. So the correlation coefficient is 0.47. Okay, so the correct answer is A. If you invest 40% of your money in A and 60% in B, what is your expected return? Well, that's a very simple question. Okay, the answer is B. Number 10, what bias arises when the return of unsuccessful funds are left out of the sample? That is known as what? Commonly, survivorship bias. Okay, it means that you look at a sample of funds or stocks and the returns look fantastic because the bad ones have actually dropped out already. So you don't get the full picture of how these funds are doing unless you count the ones that didn't make it. Okay, that's known as survivorship bias. So I hope that is okay with everybody. And these are simple questions, and I think make sure you are comfortable with them. All right, and like I said, always pick the best answer. If more than one of them look like it's suitable, okay? And so good luck for this. All right. Now, what I like to do is just have a look at some other things. And the first thing I want to do actually is just in case I didn't tell some of you guys. Now, you might remember that I told some of you in the tutorial, but maybe not the T1 people. Okay, I had a where is it? Just hold on one second. Okay, I found it. Okay, now I think you might remember that in tutorial 5 or 6, I gave you this little handout here. Okay, and this is the steps that you should follow for trying to run the numbers for the single index model. Now, in step number 7, actually this one here, it should be a plus sign. And I can't write on it. So it's step 7, when you are adjusting the weight, it should be 1 plus, the bottom is 1 plus in brackets 1 minus beta A multiplied by WA naught. When I gave you the printout, it looks like minus, but actually it's just not coming out. It's not coming out well, but it should be 1 plus. Okay, and actually it was a student who pointed this out to me. It's just a printing. The resolution is not good. Okay, so that is actually a 1. You can see you kind of can see the plus sign there. Okay, it's 1 plus, not 1 minus. So that's on the single index portfolio. Another thing that I do want to clarify, and I may not have mentioned this to the T3 and T4 people, which is that I spoke to you guys. We had a very interesting discussion, if you recall, on the Sharpe ratio and why it didn't work for George Soros and why it didn't work for the other fund, the integral asset management. So for George Soros, it didn't work for good reasons, but for integral asset management, it didn't work for bad reasons. Okay. One thing I may not have mentioned regarding George Soros is that so his Sharpe ratio wasn't really that good. Okay, so whenever markets, he was outperforming. If this was the market, he was outperforming, but sometimes by a huge margin and sometimes not. So therefore he had positive returns, almost all positive, 29 out of 30. But they were positive and extremely volatile, which meant that the sigma of his returns were also, big numbers. A solution for this actually is to use the Sortino ratio, which I have included here. Now, the Sortino ratio is different from the Sharpe ratio only in the sense that your sigma, your portfolio sigma, only looks at negative returns. Okay, so if you have a lot of positive returns but they are positive and volatile, it doesn't feature in the ratio. So it's actually when you have negative returns. Now that actually has meaning. Well, what does it mean? It means we want to know, how your excess returns compare to the volatility of your portfolio only when you are losing money. Only when you lose, and it is actually when you are losing money that the sigma, okay, can be quite big. At least for the more conventional, maybe not George Soros, but for the normal guy, what you want to know actually is not only how they make money in good times, but how they handle situations in bad times. And that's what the Sortino ratio would do. And you can see that it is, for George Soros, the Sortino ratio just absolutely went through the roof whereas the Sortino ratio for the market didn't do much compared to the Sharpe ratio. Okay, but for him, basically, it's asymmetric. Okay, he had a lot of positive returns with extreme volatility, and he practically didn't have any negative returns, and therefore the volatility of his negative returns were very small. A Sortino ratio of 7, is just truly world class. Okay. Okay, so I want you guys all of you to be on the same page. One more thing that I want to try and tackle concerns a question from somebody. So, dear Sam, sorry to bother you. I have a question when reviewing IPA Chapter 11. For the figure below, okay, hold on. I can understand the positive SMB and HML for some countries, but how can we relate it to the GDP growth? I don't find how GDP is shown in this chart. Actually, and it is not explained in detail in textbook either. One more thing to check. Does this style portfolio mean long H and short L and long S and short B? I think it does, yes. That's why the order is SMB and HML. So S is supposed to give you more return. Now, what is this? First of all, this is an interpretation of some of these so-called anomalies, okay, that are put forward by behavioral guys, and they are saying that portfolios with high price to book, okay, or small companies, okay, small companies tend to outperform the market in the long run. And well, let's just stick with one of them, whether it's SMB or HML. I'll just stick with SMB. Okay, so small companies tend to outperform the market in the long run. Now, one interpretation is asking the question: is that really the case? And if small companies really do outperform large ones, okay, then they should do it all the time, okay, whether it's a good market or bad market. Now that is how you set up a kind of empirical hypothesis. So if you believe that factor X, whatever X might be, okay, factor X would help you outperform markets, it should do so at all times. Okay, so one group of researchers, they looked into this and they say, okay, well, what about we look at SMB, and we look at SMB when the economy is good, okay, and we look at SMB when the economy is bad, okay, and the representation, the indicator they use for a good or bad economy is GDP growth. Okay, so GDP growth can be high, can be low, can be zero, can be negative. So they use that. So they're saying what happens to SMB when the economy is good, and what happens to SMB when the economy is bad. Now, if SMB truly outperforms the market, it should do it. It should be able to do so at all times, whatever the economy is doing. Okay, but what they found was that, at least according to this paper, they found that when you look at SMB in a good economy minus SMB in a bad economy, okay, there is a big difference. And this is all these blue bars, except for Australia. All the other ones are positive. Okay, so SMB, it seems that they do better that there's bigger outperformance in good markets relative to bad markets. So it may not be that small minus big is actually giving you extra return. It seems to be seasonal, in other words. They use the word here somewhere, seasonal. Maybe they did. No. Okay, I'm using that word. Okay, it's seasonal. And if it's seasonal or cyclical, if you like, if it's cyclical, then maybe it is not the factor itself. Maybe these stocks just have high beta. Okay, now what would high beta stocks do? High beta stocks would be far more sensitive to the overall market, which is, of course, to a great extent driven by economic growth. Okay, so we come to the conclusion, at least I'm not saying to you whether it's right or wrong, I'm trying to help you interpret what this paper is trying to say. So they come to the conclusion that, well, maybe SMB isn't really an additional factor, but it is just a proxy for you identify these are all high, therefore these are all high beta stocks. They are just more sensitive and they're driven by market. So when a market is doing well, they do even better. Okay, but when a market is not doing well, okay, they don't do well either. Okay, so that is, I think that is the thinking behind it. You don't have to agree. You just have to understand it. All right. I hope this is helpful. I don't want to take too much more of your time. And so happy revision and good luck, and see you soon. Thank you very much, everyone. Bye-bye.